It is August of 2025, and we have earnings season in full force here. Today, I want to talk to you about three Canadian dividend stocks, three Canadian oil and gas stocks, three great, interesting companies in the Canadian business. That is Suncor, Imperial, and Cenovus. Each of them have released earnings in the last week or two. Each of them presents an interesting and different opportunity, and I want to talk about each in a quick video here today. Welcome to Golden Larch Investing. My name is Liam. On the channel, we talk about investing in Canada. If that interests you at all, please do like the video and subscribe to the channel. We're going to start with the most controversial of these stocks. Cenovus Energy is definitely a more talked about stock than Suncor or Imperial right now among Canadian retail investors and even among Canadian institutional investors. The real question behind Cenovus for the last little while has been a difference in between their upstream or production assets and their downstream or refining assets. The upstream business has been fantastic. They own really high quality oil sands that have produced at a really great level, that have 19 years of production run, that just basically are the bedrock of this company. And then they have their downstream assets, which, while they should be this absolute profit machine, have just not been consistent or able to keep up with expectations. As a result, you've seen the stock sell off considerably over the last little while. I think they're down about 17% as I film this video, but obviously it could be even more over the last year as you watch it. All that put together gets us to a position where, honestly, there's a lot of pessimism around Cenovus. And yet, when we look at their earnings, we see a shocking difference between expectation and reality. If you just look at the screen right here, we have Cenovus Energy. It's sitting right now. This is the US listing on the New York Stock Exchange, sitting right now at $14.85 US, which would put it in the range of 21, 22 Canadian dollars. As we go down here, you see their most recent earnings came out on the 31st of July this year, with EPS beating on a GAAP basis by 20 cents and on a normalized basis by 16 cents. When you look at the actual EPS numbers, the GAAP EPS was 33 cents. That's a 20-cent beat. You look at the normalized 25 cents, 16-cent beat. It beat by more than double what the expectation was. And of course, you look at the revenue actual, that beat by 3.22 billion. It's safe to say analysts were incredibly bearish on this stock. And yet, if we look at the revisions here, where Seeking Alpha helpfully puts up a revisions grade showing how many analysts have revised their expectations for the next quarter, we see none. Nobody has revised their expectations up. Everybody has revised their expectations down. The sector as a whole, as you see right here on the sector median, about a quarter of analysts are more bullish on the sector than they were a year ago, and about 75% are bearish. And so in Cenovus's case, seeing nobody revise to the upside, everybody revising to the downside, is a 32% difference to the downside. That just shows continued bearishness. As you look through their surprise here, I think one of the best ways I've seen this visualized right here, this blue bar right in the middle, you see right there, that is their second quarter 2025. The EPS change year over year is not great, but if you compare actual to consensus, it is out of the park. Absolutely massive beat. And if you look at the last couple quarters, I mean, the fourth quarter of 24, they missed by a cent. First quarter of 20 or 25, they beat by 4 cents. So small miss, slightly larger beat, but now just a gigantic beat. And I think this goes to show exactly what the story of Cenovus is. This is a company that has its issues. Don't get me wrong. There are huge question marks about whether or not this management team makes the right decision about those downstream assets. And to be honest with you, most investors don't agree on what that right decision is. Even in the comments on these videos, I've seen investors who preach that they need to sell their refining business, and others who say that it is just the exact reason why they own the business, that they just are waiting for that moment where refining turns around and suddenly the stock is valued more like its peers. And so if you're buying into Cenovus, I think the real story that you should look for is undervaluation, underestimation. If you believe the management team can actually make the downstream operations work, or at least make a really good decision about selling those assets, not just selling low because people say so, but picking a good moment, then this is a great stock to buy. This stock is underestimated. It is definitely trading a little bit cheaper than some of its peers. And while they're not growing the same way their peers are, thanks to their underperformance, you could see a bit of a slingshot effect where because they have been held down by their short-term failures, their long-term successes will see much more percentage gain for your investment. On the complete other side of the spectrum, we've got a stock that we haven't talked about much here on the channel. It's IMO Imperial Oil. This is a high-flying darling of many Canadian oil and gas investors. Lots of people have owned this stock, bought in over the last year, 2 years, and are loving the returns. Imperial, out of the major Canadian oil and gas producers, probably has the best share price performance over the last couple of years. Now, don't quote me on that. I'm sure that there are probably moments where you could find others that have outperformed them. But across the board, everybody's been happy with Imperial. And because of that, the stock is just about price to perfection. However, when you do look at their quarterly earnings, which is from the 1st of August just there, you see that they beat on their EPS, both normalized and GAAP, beat by about 25 cents on both cases, which was a significant beat, but not massive. However, they did miss on their revenues by 730 million Canadian dollars. So while they did beat on their EPS, they missed on their revenues, and neither was a huge miss or a huge beat. However, the market treats Imperial completely the opposite they do Cenovus. They trust this stock. They trust the management team. This is a stock that has been firing on all cylinders, and so revisions are actually quite positive. If you look right there, we've seen 6 revisions to the upside over the last 90 days versus 5 revisions to the downside over the last 90 days, which puts them actually significantly above their 5-year average, significantly above the average for the energy industry, where about, let's say, 3/4 of analysts have actually become more bearish over the last little while than bullish. As we go down and we look at how the past couple quarters have gone, we see that their EPS has surprised just about every time. And again, that's part of the story of why the market loves this company. They trust management. They trust the performance. They expect things to continue to go the way they're going. Imperial is going to suffer the same setbacks as the rest of the oil industry. Cheap oil prices, Imperial suffers. Significant trade war imbalance between Canada and the US. Not Cenovus. Well, I guess they do. But Imperial also suffers. But Imperial is one of the best positioned overall in this industry, and the market has rewarded them. If you're buying this stock, you're probably buying because you believe they will continue to outperform in the long run. Or you're buying because you trust management and you're willing to hold for that fantastic dividend over the long run. You trust that they know what they're doing, they've been here long enough, and they're big enough and backed by big enough backers that you're not worried about short-term headwinds or the prospect of takeover. If we go down a little bit, we look at some annual EPS estimates, you basically see the same kind of story as the rest of the industry. You see that December 2025 looks pretty good. December 2026 looks a little bit less good. If we zoomed out on that chart and you looked at 27, 28, I would expect that you would see EPS estimates going back up into the high 7s, maybe into the 8s. Same kind of story with revenues. You'd expect to see a little bit of a slingshot effect overall for the industry, but Imperial definitely has the most to fall if you do see management falter. That's the one thing I'm going to say as a sort of a slightly bearish take. I think Imperial is fantastic. I think if you own it, you probably are holding it for the long run. Management has continually outperformed, but I've been burned before by companies like this that are constantly firing on all cylinders. The market loves them right up until they miss. So I would watch out. If you see in Q3 or Q4 of this year, you see the miss on EPS, you could see an outsized reaction to the downside. The third company we're going to talk about today is Suncor Energy. Suncor is a bit of a mixed bag. Well, they did beat their EPS on a GAAP basis. On their normalized actual basis, they actually missed it. However, they did beat by their revenue. Suncor is not the same golden child that Imperial has been over the last couple of years, but they're not the same troubled story that Cenovus has been. They really do sit a little bit in the middle. They offer one of the most interesting takes on the entire oil industry because they're probably the most well-known name if you've been investing longer than 10 years. Suncor is one of those integrated majors, and really they do have a fantastic business that has stood the test of time. If you're buying the stock, it's probably because you trust them, you want to hold them for the dividend, you want to hold for 5, 10, 15 years. And I really think they're set up for that kind of time frame. If we go through a couple of these numbers here, you see that like basically the whole industry, they've got 75% revision to the downside, 25% to the upside, which puts them literally on par with the whole energy industry up here in Canada, which again kind of reflects how the market treats them. We continue to go down. You've seen that over the last couple quarters, we have some significant beats. We got 36 cents in Q3, 11 cents in Q4 of 2024. We got 4 cents Q1, and just that tiny miss on an actualized basis in Q2. EPS is estimated just like we talked about. It's dropping a little bit between 2025 versus 2026, but that doesn't mean that you're not going to see it accelerate into 2027 and 28. Just again, like the industry, they have fallen behind a little bit. And just like the rest of the industry, they're expected to have a better time 27, 28. I would expect also 29, 30, when you do see so many of those headwinds get out of the way, maybe becoming tailwinds. Revenues aren't expected to grow a huge amount over the next little while, and so you shouldn't expect to see huge growth there. I think overall, Suncor does stand at a really interesting point where they are not quite as loved as Imperial, but that also means they don't have the same kind of premium on them that Imperial does. I think if you see similar response from Suncor, similar performance, just, trucking along, being consistent, you're going to see the same kind of investors hold their shares. But as time goes on, if you see a little bit more outperformance, or if you see the industry start to recover a little bit, I think you'd expect Suncor to have a little boost to their stock price. I think if you're buying this stock, it's because, again, you trust them for consistency, just like Imperial, but you're not quite willing to take the risk that you're willing to hold Imperial with. You're not quite willing to see if there is that short-term drop in which you might lose out on a little bit of potential. The last thing I want to show you guys here is a chart. Now we're jumping over to FinChat for this one, fiscal.ai. I'm going to keep doing that. But we have a 10-year chart here just on the bottom of the screen of Cenovus, Suncor, and Imperial. And I think you can see the story that's been playing out here. Suncor is really a legacy name, and for quite a while, up until about 2020, they were performing the best out of the group. But after that 2020 drop, and as everything started to recover, we've seen a consistent story. Cenovus on the bottom, Imperial climbing fastest, and Suncor right there in the middle. And as it sits today, you can see that Suncor is up 115% over the last 10 years. Not great, definitely not beating the market. But right in the middle of Cenovus, who's up 5% on a total return basis over the last 10 years, definitely disappointing. A lot of investors are not happy about that. And Imperial's up almost 200%. So while Imperial's been a high flyer, they've performed really well, you could really see an interesting bounce back story from both Suncor and Cenovus, depending on the level of risk you're willing to take and how much you're willing to trust that management will turn things around, or in Suncor's case, more or less keep things on the right track and avoid any sort of shortcomings in the near future. All in all, I think the person who's buying these stocks is investing for the future in Canadian oil and gas. You're investing for that 5 to 10 year opportunity where you could see huge amounts of profits coming into this industry. Maybe you're going to see new pipelines. You're going to see the decline of US shale oil. You're going to see oil becoming more in demand on the North American market. You're going to see a WCS, WTI parity. All of these elements that could dramatically impact all of these businesses see significant amounts of profits flowing into them. You're going to see the assets they own, both up and downstream, become more valuable in that future as they become more and more critical for providing for the huge amount of energy infrastructure here in North America, the increased power demand from things like artificial intelligence, and the demand of all these LNG facilities that are coming online. All of these companies sit at a crossroads right now. And the one that you pick, the stock that you like the most, is really up to your investing style, the risks you're willing to take, and what you're looking to own. And with all that being said, I hope you enjoyed the video. I would love to hear from you in the comments. What stock do you prefer out of these three? Are you buying Suncor, Imperial, or Cenovus? And if there's another stock in this industry that you think beats them all, has some of the same kinds of assets, has some of the same kind of opportunities, but performs better, I would love to hear that in the comments as well. If you made it this far and you like the video, please do give it a like. If you like what we do here on the channel, please do subscribe, and I hope I see you in the next one.